Scott Bauer, Prosper Trading Academy CEO. Thanks for joining this conversation. And what do you make of it? Do you think that the testing of the June lows, do you think that this is it and we are going to see some sort of capitulation bottom soon? Or do you think that the inverted VIX curve, those investors somehow have it wrong?
So you're spot on, Abigail. Persistent inflation, fears of an economic slowdown, rising rates, they've all led to this rise in VIX. Not a spike, though. Not a spike, just a rise. So capitulation is not near. We got to 35-ish in June, and that's been pretty much the high all year. Typically 40 in the past, historically, is more that capitulation level. So I don't think we're there yet. However, when the yield curve or the VIX curve gets inverted, it's called backwardation. And what that means is that intraday ranges, like we're seeing right now, they expand in size and velocity. And there's also bigger chance for like an overnight gap. So what backwardation means is that the fear of volatility is here and now. Likely to subside in the future, but here and now. People want protection right now, not so concerned about it a month, 2 months, 3 months down the road.
And we're seeing that backwardation or inversion here at this terminal chart showing, again, the near-term VIX, the spot and futures higher than further out. That typically is not the way it is because there should be more risks as time goes on. So what does this say about the Fed and rising rates, Scott? Because it really seems to be that 2-year yield popping sharply higher, 10-year yield, the prospect of the Fed continuing to raise rates, other central banks. That's certainly one of the biggest drivers of rising volatility.
No doubt about it. And I think that says that imminent meaning over the next 30 days or so, or whenever the next Fed meeting is, another big raise, another big interest rate rise based on this. But then things subsiding. And as you guys were talking about earlier, maybe even by first quarter next year, no more rate hikes, possibly even a pullback, but no more rate hikes. So the imminent fear, if you will, is really about 30 to 45 days out going to the end of the year. As you mentioned, that VIX goes from 33, 33 and a half where we are right now down to about 30 for the December future.
And is this why we have that put-call ratio and the skew index still not really confirming some sort of fear or panic in the market?
Right, that skew index is not confirming that. So, this whole slide down over the last, month or two, VIX really stayed in the mid-20s. It never really popped up until about the last week or so. And we have not seen the skew pop, meaning, put options being more expensive relative to call options. So we haven't seen that yet, which again, another great indicator that capitulation is not here.
Well, it's going to be interesting, of course, to see what October brings. September is seasonally the worst month, but funny enough, this year it's actually not the worst month. I think that was back in April. It'll be interesting again to see what October brings. Scott Bauer, Prosper Trading Academy, thanks so much for joining us for Options Insight today. And from New York, this is Bloomberg.